you, Kelly.
Okay, I would like to introduce, hold on a minute. Okay. I would like to introduce Colin and Amy. Colin Roth is the charitable planning specialist and institutional relationship manager with Fidelity Charitable. And prior to Fidelity Charitable, Colin was spent 7 years in the wealth management industry as a financial planner and advisor, most recently with Bernstein Private Wealth. Colin was my first contact as my clients were looking at selling their company. Amy Grossman is the attorney at Fidelity Charitable, who is the complex asset specialist. Prior to Fidelity, she's been with Fidelity for 7 years. And prior to that, she was the managing director at Credit Suisse in San Francisco and headed up the corporate and executive services group and was a subject matter expert on restricted stock. Prior to her switch to financial services, Amy was a private law practice in San Francisco and Palo Alto. And on that, I'm going to turn it over to Colin, I think is going to be speaking first.
Thanks so much, Kelly, and thanks to this Provisors Affinity group for having us. It's such a great group, and really enjoyed as well those breakout sessions at the beginning. Nice way to ease into things here. All right. So very quickly to set the stage, a quick about Fidelity Charitable. Fidelity Charitable Gift Fund, we are an independent 501c3 public charity. So, think of us as you think about the Red Cross or perhaps your local food bank or the Salvation Army, established in 1991. And simply, Fidelity Charitable's mission is to democratize the philanthropic process by growing the American tradition of philanthropy and providing programs that make charitable giving accessible, simple, and effective. And the primary we do this is by administering what's called a donor advised fund, also referred out there as a DAF or DAF. And when you hear the term giving account, if that's ever referenced throughout this presentation, that's just to reference what we call our donor advised fund accounts. And another two, just to take a step back, if you have not heard of donor advised funds or DAF programs, I use 3 keywords to describe it, just to keep it as simple as possible. And that's give, grow, and grant. And there's kind of some planning that goes alongside in each of those steps. But Amy and I spend a lot of our time on the give side, so helping you and probably your clients be impactful philanthropists by simply selecting the right asset to give to charity. So that's a lot of what today's presentation is focused on. But there's also 2 key steps that follow that, and that's what happens within the donor advised fund after that gift is made, and there's certainly the opportunity for reinvestment and for that money to grow in a tax-free environment. And then finally, the most exciting aspect of what we do every day is granting, and that's helping our donors grant funds from their donor advised fund to the true end charity they want to support. And there's a lot of numbers on this slide, but the ones I'll just really highlight because we are so proud and excited about them are that number in the top right. $61 billion is the amount of money since 1991 that we've distributed out the door to public charities in the United States and also abroad in some cases. And the number in the bottom left is the number of unique nonprofit organizations we've supported since inception, and that's 357,000, which is a really remarkable number. So we're incredibly proud about that, and always want to share that this is a lot of times coming from your great advocacy. So it would not be possible without all of you and having this all important charitable planning conversation with your clients. So today we're going to spend a lot of time on what we call complex assets. And I think that's a little bit of a misnomer to a degree. When we say complex assets, what we really are referring to are non-publicly traded assets. And one myth we really want to dispel here is the complex nature of that conversation. Certainly, knowing where your resources are is one big thing. And that's where, certainly Amy is a tremendous resource. As you'll come to learn. But just the idea that working with clients on non-publicly traded assets is not a complex process, not a complex conversation, and we're here to help you. So we're going to talk about why they are so powerful from a philanthropic efficiency standpoint. We're going to spend time, of course, talking about what those are and some good examples. We're going to spend a lot of time on a really great case study and also some live examples around, who the right clients are and when you might see this in your day-to-day. And finally, we'll close out with just, refreshing you on where your resources lie and what types of things, you might want to be aware of when having this conversation. So as we get started here and we really focus in on charitable giving, these are really the broad swath of categories of assets to be used to fund philanthropy. And one thing I really want to hammer home is cash is the least efficient asset to use for charitable giving. And the principal reason for that is when using cash from a charitable giving standpoint, you miss out on one of the most tax efficient components to charitable giving, and that's the ability to ideally reduce or hopefully mitigate a long-term capital gain. So by using a long-term appreciated asset that might find its form as a stock or a mutual fund or an ETF on your client's balance sheet, or it might be a client with private business interests, C Corp stock, S Corp stock, restricted stock units even, or even cryptocurrency. So we'll get into those examples later. But just the nature that a long-term appreciated asset, when given to a public charity that can accept it, offers your client as the donor the opportunity for a full fair market value deduction at the time of the gift, the opportunity to reduce or eliminate the long-term capital gains tax. And finally, because it's being given to a charity and they're handling the sale and disposition of the asset, ultimately allowing it more money to flow for charitable giving. So a win-win on both sides, not just from the donor reducing their tax bill, but also in the amount of money that lands with the charities that need the money to operate. And so you think in understanding that, cash is the least efficient asset, that all these donors out there with, the brightest of advisors would be using a lot of those highly appreciated assets in their charitable giving. But the fact of the matter is, of the 80% of donors that own these types of assets, only about 21% of these donors are actually contributing this asset to charity. And could be a variety of reasons for this, but it's more likely than not is probably due to the fact that they aren't aware of this strategy, or they're not getting that good advice that they really need. So that's really why we're here today, to help you and be a resource and hopefully be that sounding board as this topic comes up. So with that, I'm going to transition over to my colleague, Amy Grossman, to share more about our complex assets expertise.
Great, thanks so much, Colin. So as you can see here, the trend is increasing as advisors become more aware that donors can contribute things other than cash and publicly traded stock. Last year, we accepted over $2 billion in these non-publicly traded assets, and that was just a little more than 10% of the overall contributions into the donor advised fund. I think last year was 17 billion was total contributions, but 2 of that was these non-publicly traded assets. And our group consists of 4 attorneys. We're going to be adding one next month. And of that $2 billion, we had the $2 billion was represented in over 325 different companies, different assets, with over 1,000 donors. So you could see we were very busy. And one thing I want to point out is, being the largest donor advised fund, we are very, very cognizant of the fact that, with these non-publicly traded assets, what we don't want to accomplish is facilitating tax deductions for people, but not having the money go to end charities. So we really want to make sure that we're going to have an imminent exit strategy. And in fact, the average holding period for these complex assets is about 90 days, and 96% of these assets are sold within 1 year. So Colin, let's go to the next one. So some examples of complex assets: about 85% of what we accept is private company stock, and that's in the form of S Corps, C Corps, and LLC interests. We accepted, I think since inception, when we started accepting cryptocurrency, about 325 million so far. We accept Bitcoin, Ethereum, Litecoin, private equity hedge fund interest. That comes up a lot towards the end of the year when donors, they no longer want to hold these fund interests. As long as we have a way to redeem quickly, we're happy to take these interests. We also work with a lot of private equity principals that want to contribute carried interest. So that's something that we can accept as well. And just like I said, just the fund interest, as long as we have an exit plan. A large amount of what we do accept is restricted stock. And we put restricted stock in the complex asset category. We have a case study about this later. Generally, when the stock is owned by affiliates of the company, and for some reason it can't be sold, it's either in an underwriter's lockup period or there's a closed trading window, but they can still donate the stock. So we'll have to hold it for a while. And we can, again, we'll talk about this more in the case study, that the donor would need to get an appraisal for that. Insurance interest, we take some of that where it's whole life insurance. Haven't done too much of the oil and gas royalty interest, but we have a few. We put real estate down here as a separate category. Very recently, we decided that we would not be accepting real estate in kind, where we have to take title to the asset. In my 7 years, I have done a couple of those where we've taken the, an interest in a house, and then it's really me of these 4 attorneys that's then, working with the people to get rid of the washing machine and in the garage and mow the lawn and do everything that a homeowner would have to do. So it's very, very time consuming with real estate in kind. We do absolutely accept real estate, whether it's residential or commercial, if it's in an LLC. And in that situation, we would take a minority interest. The donor would work to sell the property, and then we would just get a distribution once the property is sold. So that works out really nicely. And alternative investments, I mean, that's sort of the real catch-all, other weird stuff. I remember one was, I think it was a fractional interest in a racehorse or something that was in an LLC, but we ended up not accepting that. We thought that that was going to be a little bit too risky. But, it's always worth a conversation. And one thing that is absent here is art and collectibles. That's something that we do not accept. And that's primarily because of you might know, the related use doctrine. If the asset can't be, our mission is to sell these assets and have money available to charity. So the donor would be limited to just a cost basis deduction versus where the charity can use the asset like a museum, then they would get the full fair market value. So we work with partners who can accept those assets, but that isn't something that we include in our complex asset portfolio.
So I'll jump back in here quickly, and thanks so much, Amy, for that backdrop. And there's a lot of information on this slide, but the one other critical piece I just want to draw everyone's attention to from a tax deduction and tax planning standpoint are when these types of assets are potentially being considered for a variety of giving vehicles, perhaps a donor advised fund, or perhaps a family private foundation. And non-publicly traded assets that being gifted to a foundation are actually only deductible at cost basis. And so certainly if you have clients thinking about this type of strategy, you're having that in mind, you're probably going to want to steer them in the direction of either, sending it directly to a public charity that can accept it, or a donor advised fund, just because of that fair market value deduction based on an appraisal that Amy will touch on in a bit here.
Great. So we are going to touch on 4 case studies, but primarily focus on the private company business exit, because that is the one that Kelly and I worked on together last year, which was a great outcome for the client. But I was chuckling, Colin, when you said that these transactions aren't really complex. That one happened to be a little bit more complex. And that's what might make it more, exciting for this presentation. But, generally, they can be extremely cookie cutter, or have a lot of hair on it or some wrinkles, but that's what makes it fun. I touched on before equity compensation. That's really the restricted stock where there's some sort of a holding period. Public company M&A is really interesting when there's two public companies that are combining and there's a capital gain event there. If the timing is right and there hasn't been a shareholder vote, it's possible to make that contribution and avoid the capital gain, but many people overlook because they don't think about it. And the pre-IPO situation, very interesting here for people in the region where I am, which is in Silicon Valley, Northern California. Again, it's very important that there be an exit strategy. So we'll talk specifically of when we cannot accept these pre-IPO companies. So if it's super early stage and there isn't some sort of secondary market, that might not be the best fit for us. But we're happy to take shares that are in some sort of a underwriter's lockup or very close otherwise to filing and going public. So I think that this is the most important slide in the presentation, and we'll get to Kelly's case study next, but this really is the cornerstone for every single complex asset donation. If we had a client on the phone, we would really take them through this matrix because all of these issues are relevant no matter what the fact pattern is or the asset. And really the most important one that we would speak on first is the bottom left, liquidity and timing. That's also what we would refer to as the exit strategy. So as I mentioned before, we want to make sure that there is an imminent path to liquidity. And that looks like somewhere, less than a year, ideally a lot less than that, but very, very important that there is no binding agreement for sale. We're often dealing in the zone, in the time frame between a letter of intent and the final sale agreement. But once the sale agreement's been signed, that's our line in the sand, and that's too late. We frequently get donors who have signed an agreement and there's that time period between signing and closing, and they say, well, it's not a done deal yet. I should be able to do this. I mean, that's for us. We think that is too risky. Just from a reputational risk, we won't accept it and wouldn't want to put our donors into a situation that might be questionable, because once there's an agreement signed, then the IRS could say that was an anticipatory assignment of income or an assignment of income, and the gain is already attached, and you can't avoid the gain by giving the asset away. So that time between the letter of intent and the final agreement is really the sweet spot. Now, the easiest part of a complex asset donation is the transferability. And that is starting out with our due diligence, where we will gather all of the corporate governing documents and just work with company counsel to lift any restrictions, get board approval. Sometimes there's rights of first refusal for the company or other shareholders that need to be waived. And also we want to take a look at the governing documents and make sure that things like drag along rights are not problematic for us. And I'll get to that next in the risk part of it. But then moving on to valuation, there's really two prongs to that. And the first one is something for us, the charity, just that we have to have a good understanding of the value of what we're receiving. Now, certainly the letter of intent is a great way for us to ascertain that. We'll ask for financials if it's a C Corp, the 409A valuation will be great for our purposes. But from the donor standpoint, in order to substantiate his or her tax deduction, the donor will need to get a qualified independent appraisal as of the date of the gift. The good news is that it doesn't have to be done prior to the gift. So no hair on fire to go out and get an appraisal before the gift is made, as long as it's done before the donor's tax filing deadline. And there will be some discounts there for lack of marketability, lack of control. We only accept minority interests. And, happy to answer any questions on this later on and not spend too much time on that now. It can be pretty intricate. But the risk management section is really three sub issues there. The first one is unrelated business taxable income. So if we're dealing with accepting an S corporation or an LLC where there's underlying debt or hot assets, there most likely will be unrelated business taxable income for the charity. And certainly with S corps, all of the gain is unrelated business income. And that's just an IRS rule, not unique for Fidelity Charitable. And how we handle that, we really have a well-oiled machine. We have a questionnaire that the donor would receive, and their tax preparer would help fill that out. We send that to our corporate tax department, and we'll come up with a good estimation of what our UBIT rate would be, and we escrow that. So that's not available then for grant making. We'll escrow that separately from the proceeds. Another area of risk is what happens if the deal falls through? You've already made the gift because it had to be done prior to the binding agreement. And there are certain situations where at the 11th hour, the deal falls through. In that situation, or one of the conditions is for us to ask for a redemption right back to the company. And that would look like if after a period of 1 to 3 years, we're still an owner, we would have the right, but not the obligation to have the company get an appraisal at that time and buy our shares back. We don't do this back to the donor. There are some donor advised funds that make a regular practice of that. We don't like the optics of selling back to the donor, so it is back to the company. And then the final area of risk, and I'll save this as well for our case study, but that's really deal risk for us as a seller. And for the attorneys on the phone and the M&A bankers, you'll know that as a seller, we might be asked to indemnify the buyer for breaches of company reps and warranties. We obviously can't do that. We don't know anything about the business. We can't take that risk. So we'll ask that the buyer look to the donor to fill that gap where we can only rep to our ownership and things that we can independently verify. Okay, so Kelly, I've been hogging this for a bit, so let's move on to you in the next one. I'll just set the stage. In this particular case, your clients had they were selling their business and they were charitable, and you gave them this idea to rather than wait and pay the capital gains tax and donate the proceeds, donate the I think it was the C Corp shares.
So my clients contacted me and said their company was being sold, that they'd founded 10 years ago, was being sold. It was a C Corp. The transaction for them was approximately $20 million. And I did know that they were charitably inclined. So having sat through a presentation by one of Amy's colleagues, I knew that we needed to get this ball rolling quickly because the letter of intent had been signed, but the actual sale had not been signed. And the time frame when this was first presented to me was very truncated. It was a lot shorter time frame that I normally would have expected or wanted, but I got a hold of Colin. This was qualified small business stock. At the time, we were also working with on the tax side. How do we plan for taxes? Because the qualified small business tax treatment was in flux, limbo. And so the clients, to further complicate it, the client and spouse together, they make a significant income of about $1.2 million in consulting fees a year. We got a hold of, Amy got a hold of this, went right to work. I know Amy's going to go into a little bit of detail on the complexity that she was able to work through with the various owners and investors. The end result for the client was they were able to contribute about $3 million in stock to the donor advised fund. And depending on how we end the year with tax treatment on qualified small business stock, if it remains as it is, they will have a tax savings of a little over 700,000 this year and next year. If they, that's under the qualified small business stock treatment of 50% is taxable. Under the current QSBS tax treatment, they will save about 203,000 a year each for the next 6 years. So it's been a significant tax savings as well. As for the intricacies of the deal and the truncated time frame, Amy, I'm actually going to turn that over to you because you were in the ditches working on this.
Yeah, I remember working on this over Thanksgiving, actually, and calling from my folks' house and in between trying to get a little bit of skiing in. But that's the way it works. And what's nice about us is that we don't have to generally go to outside counsel or get other approvals. It's very efficient, and we have signing authority. So getting the shares over was the easy part. Working with company counsel to get all of the required waivers and consent. We had the stock transfer agreement in hand, ready to go. And I say have that on the shelf. The difficult part about this transaction was the risk element and those carve outs to the reps and warranties. And in all my 7 years of being here and doing these transactions, we've not had a problem with the buyer accepting the carve outs where we, like I said, we just make reps to our own ownership, that we don't encumber the stock. The donors were very willing to step into our shoes, but buyer's counsel was very recalcitrant on offering this carve out. And we were all saying, I think people were really over lawyering it and just trying to add this extra complexity. The CEO had to get involved where it was even a business issue, that it was really important that the clients make this gift, that they were good for it. And ultimately we got the carve out and we were ready to move on. And we make sure that we do this before we accept the asset, because the last thing that we want to do is become a shareholder and then have issues with the deal where we're holding it up. So yeah, there was some back and forth, but we want to make sure that our donors understand that they need to socialize that idea with the buyer, that there's a charitable shareholder involved and that not all sellers can be treated the same. But we were able to get that done, and everybody was happy. Yeah.
Yeah, the clients have saved some nice taxes on it too. So even for clients that aren't necessarily philanthropically inclined, but are interested in saving taxes, this is a great strategy as well.
Yeah, and what's nice about this too, I think it was in this situation, there was another shareholder. And sometimes we have this situation where one shareholder wants to make the charitable contribution, and then when the others find out about it, they get on board as well. So you can have multiple shareholders making the same donation, and you have one charity rather than someone trying to go to the community foundation or to the Red Cross, and that would drive council crazy, have all these different agreements, different charities on the cap table. If we were to work with other shareholders, then once we liquidate, as soon as we liquidate, that donor is able to make a grant right out to another charity. So there's no requirement that the assets be held with us. And in that situation, there aren't even any fees involved, because we were really facilitating it, and then they can make their grant to the charity or charities of their choice. And I don't know, Kelly, if they've gotten the appraisal yet, but
Yes.
yeah, they did. Great.
Yeah.
And also in this situation, what was nice about it was we made an exception to the redemption right. I think that was really going to be a gating factor. There were, in this situation, many sophisticated private equity investors, and there's no way, especially in the pre-IPO scenario, when we're working with institutional investors, that they would agree to have the company, use company funds to buy out a charity. So in this case, we made an exception. These were really, prime, top level private equity firms, and we felt comfortable that the transaction was going to happen, or that there would be a plan B, and perhaps a secondary market. I remember, Kelly, that being when I mentioned that to you first, I think you sort of turned white. It was like, oh, we didn't know about this. So we were able to get that accomplished, which was good. Do we have anything else to add on this one before we move?
I don't think so, unless somebody has a question. Nope. Continue on.
Okay, great. All right, so equity compensation, this is relatively straightforward, but a lot of companies and donors, particularly executives, they may be in a closed window, and it's at the end of the year. They would like to have a tax deduction. It was a high income year for them, so they'd like to get the tax deduction in the current year, but they are not able to sell the shares. But working with company counsel, in almost all cases, they can donate the stock as long as the charity agrees to abide by the company insider trading policy. And that is a very frequent occurrence in the fourth quarter we see happening. I would say give a good 2 weeks in advance if you can, just working with the transfer agents. But we do advise the donors get an appraisal, because the stock is not immediately saleable. In that situation, that should not be very expensive. Probably in in the more closely held company, you may be looking at double digit, single to double digit $1,000. That's an out-of-pocket cost for the donor. But when you have multiple donors, they all can really get that efficiency by using the same appraisal and getting that cost down. So to the extent that your clients are interested, we're happy to hold the stock in that situation until the window opens, or again, during some sort of a contractual lockup. And in that situation, clearly we wouldn't require some kind of a redemption right, because we have a plan. We do get a lot of questions from advisors about gifting RSUs or gifting options, and we can't accept. We wouldn't be able to accept anything that's not vested. Options are not a good asset to give, because once, especially non-qualified stock option, if the option's gifted to a charity, once the charity exercises, the donor still has the tax liability, income tax, between the exercise price and the fair market value at exercise. So they're stuck with the tax bill, even though they no longer own the asset. So not a good outcome. The stock has to be vested and held for a year. Okay, let's do the M&A. Yeah, this was a really, I had an interesting real life situation with this, where a financial advisor was working with the CEO of a company. It was a public company, and it was being sold to another public company. And although the CEO was a client, the CEO donor wanted to give an opportunity to the financial advisor at the investment bank that was advising the company on the deal. So the existing financial advisor had a lot of work to he was in a competitive situation to try to get the assets and manage the assets from the proceeds of this M&A transaction. And I had recommended that they think about the donor advised fund because the wife was charitable, but this, I remember this advisor saying, you know, he's going into the home on a Saturday morning to do this presentation and said, you know, this client has the attention span of a gnat. I don't want to bring up, you know, another thing. And it was all really about, okay, you know, investment choices and asset allocation, but, you know, put in the idea of the donor advised fund that if the shareholder vote has not happened yet, and that's the key thing. So even though in that situation, there's a definitive agreement, the shareholder vote hasn't happened. So that's the window of opportunity when they can make the gift. And what was funny there was they put this idea in the presentation, gave it to the client, and when the advisor went to the client's house, the very first thing that the wife said was, I want to do this. I'm really interested in this donor advised fund idea. So that advisor was able to win all of the business. And it's nice to just sometimes, you know, you're leading with philanthropy and thinking a little bit outside the box. So the last one, pre-IPO. Well, this is very, very interesting in this area. And I'm sort of laughing because I remember working with a donor who was a managing director at a private equity firm, Andreessen Horowitz. I can say it because that they've authorized me to, you know, that it's not confidential. But this partner had heard about the idea of donating complex assets, needed a big tax deduction in the current year, and called me at 4 o'clock on Friday, December 29th. And I already had my martini in hand, and it was, you know, just the weekend, New Year's Eve around the corner, and had two companies that were going public eventually, but these were unicorns, you know, absolutely like blue chip names. So we said, okay, look, if you can get corporate counsel on the phone and we can work with them quickly to get the restrictions lifted, we can take it. So on one of them, there was this Byzantine right of first refusal for the other investors. Counsel had to scramble to be sending things to people on yachts over the weekend, but they got got those waivers, and we were able to accept both of these assets. And it was about $5 million between the two. And what was nice about that, when we debriefed the following January, the private equity firm said, you know, that the pain point there was the ROFR and having to, you know, at the 11th hour, go chase around all of these other investors. And so they're putting now in their term sheets that transfers to charities, 501c3 charities, are exempt from the ROFR. And that's really nice to see. And hopefully, you know, if there are folks here on the line that do work with corporate formation documents, might want to think about that in the transfer restrictions to making exceptions there for charities. We would still, of course, have the same restrictions, and we would need to get these waivers and consents, but at least the transfer to the charity would be simple and streamlined. So that's and my construction guys are just starting to get really loud, so that was good timing. I'll go on mute unless there are some questions.
I would just say very quickly again, and thank you all for allowing us to visit with you today. If there are offline questions that you'd like to ask, I mean, please don't hesitate to reach out to Amy or I want to make sure we add our email addresses to this slide. I mean, we welcome any and all reach outs, and also the opportunity just to be a sounding board as you might be thinking about this for certain clients.
Okay, any questions from anybody in the group? All right. Okay, well, I want to thank you, Colin and Amy and Kelly, for being here, and